It is taught in every trading book, whispered in every forum, and presented on every financial news network. The head and shoulders formation, a supposedly reliable harbinger of a market reversal, a visual map of waning bullish conviction. Yet data compiled within the lab suggests a chilling counter-narrative. In markets dominated by high-frequency trading, the more perfect the pattern, the higher its probability of catastrophic failure. This is not a random occurrence. It is a hunt. The pattern is not a signal for the informed trader. It is bait for the consensus. The logic appears sound, almost intuitive. An asset rallies, forming the left shoulder. It pushes to a new high, the head, before retreating. A final, weaker rally attempt forms the right shoulder, failing to surpass the previous peak. This sequence paints a clear picture. The buyers are exhausted. The neckline, a level of support connecting the lows of the formation, becomes the line in the sand. A decisive break below this line is the trigger, the confirmation that sellers have seized control. Millions of retail traders are conditioned to see this and act, placing their sell orders, their stop losses, and their faith in this textbook image of a topping formation. They are acting on shared knowledge, a collective belief system built over decades of technical analysis. But in the architecture of modern markets, this consensus is not a shield. It is a target. The very act of recognizing the pattern collectively creates a vast, concentrated pool of liquidity. And where liquidity pools, predators gather. The predators, in this ecosystem, are not human. They are institutional algorithms. They do not trade based on visual patterns. Their objectives are far more primitive: order execution and liquidity acquisition. They need to buy or sell enormous positions without alerting the market, without causing the price to move against them before their orders are filled. To do this, they need a counterparty. They need a large, predictable group of traders who will all act in the same way, at the same time, at the same price. They need the textbook pattern trader. The head and shoulders formation is not a signal to these machines. It is a map, a detailed schematic showing precisely where the retail herd will place their entry orders to go short, and, more importantly, where they will place their stop-loss orders. The neckline represents a massive concentration of sell-stop orders, the trigger for breakout shorts. The area just above the right shoulder becomes a dense forest of buy-stop orders, the pain threshold for anyone who shorted too early. But the real power of this mechanism is not passive. The algorithm does not simply wait for the pattern to appear. Under certain conditions, it helps sculpt it. To understand this manipulation, we must first examine the flaw in the retail trader's core logic. The trader believes they are observing an organic process of buying and selling pressure. The lab's analysis reveals they are often observing a carefully managed theatrical performance. Consider the formation of the right shoulder. This is the critical phase, where the trap is refined. Algorithmic participants can subtly inject sell orders to cap the rally, preventing price from rising too high and preserving the pattern's symmetry. They can withdraw bids to create the illusion of weakness, encouraging more traders to anticipate the breakdown. Each transaction is minute, often invisible to the human eye, but in aggregate, they paint a picture of failing momentum. They are not trying to predict the future. They are manufacturing a consensus about the future. The goal is to maximize participation, to draw in as many believers as possible before the true move begins. The more traders who see the obvious bearish pattern, the more fuel is available for the subsequent ignition. The pattern becomes a self-fulfilling prophecy, but its fulfillment is designed for the benefit of its architects, not its believers. Now, the stage is set. Thousands of eyes are watching a single line on a chart. Short sellers have their orders stacked, ready to fire the moment the neckline is breached. The volume profile shows a dramatic increase in resting orders, a coiled spring of latent selling pressure. The illusion is complete. The consensus is absolute. The price action becomes slow, deliberate. It drifts down towards the neckline. It touches the line once, twice. Each touch builds the tension. Then, a single, decisive candle pushes through. The breakout traders are in. The textbook signal has been confirmed. For a fleeting moment, they are profitable. The pattern worked. But the breakout was not the signal. It was the trigger. And the orders it triggered were not the predators. They were the prey. What happens when the hunter becomes the hunted in less than a heartbeat? For the breakout traders, the trap has sprung, but they don't know it yet. They see the price move in their favor and feel the rush of validation. But the algorithm's true objective was never to ride the trend down with them. Its objective was to engineer their failure. The critical question is this: who is taking the other side of all those sell orders? If millions of retail accounts are simultaneously selling, who is quietly, patiently, absorbing that immense pressure? The answer is the architect of the trap. The institutional algorithm isn't selling here, it's buying. It is accumulating a massive long position, camouflaged by the panic of the breakout. Every retail sell order is a brick in the foundation of the algorithm's true position. The breakout was not a confirmation of a downtrend. It was the final collection phase. The machine needed to ensure maximum participation, to gather as many short sellers as possible at a predictable, concentrated level. It needed to know exactly where their collective pain point was, and the textbook pattern provided the map. Now, with its position loaded, the second phase begins. The reversal. The algorithm switches from passive absorption to aggressive ignition. It unleashes a rapid-fire sequence of large buy orders. The subtle manipulation is over. This is a show of force. The goal is to drive the price back above the neckline as violently and as quickly as possible. This is what we call the stop cascade. The initial move creates a psychological shock. Every trader who shorted the breakout is now instantly underwater. Their small profit has evaporated and turned into a rapidly growing loss. Their pre-planned stop-loss orders, placed neatly above the right shoulder for protection, are no longer a shield. They are now fuel. As the algorithm's buying pressure pushes the price higher, it begins to trigger the first layer of these stop-loss orders. Now remember what a stop-loss on a short position is. It is a buy order. These are not discretionary decisions made by panicked humans. These are automated orders, preset and ready to fire. And this is the genius of the trap. The algorithm's buying creates more buying. The panicked shorts, in their automated attempt to exit their losing trades, become unwitting accomplices in the price surge. They are now bidding against each other, pouring gasoline on the fire that is burning down their own accounts. The price doesn't just drift up. It explodes in a violent short squeeze, engineered from the very beginning. The perfect head and shoulders pattern was not a topping signal. It was a launch pad. The slaughter is ruthlessly efficient. In a matter of minutes, the consensus is bankrupted, and the algorithm is sitting on an enormous, unrealized gain. It has not only taken the money from the breakout traders, but has used their own risk management against them to amplify its results. But this reveals a far more disturbing truth. If algorithms can so easily construct and detonate these traps for the retail consensus, what happens when they turn these weapons on each other? What does a war between machines, fought with capital and code in the span of microseconds, actually look like? The hunt for retail liquidity is merely the opening act. The main event is a conflict on a scale that is almost impossible to comprehend. This is the world of algorithmic apex predators. But what if I told you that not all of these digital predators hunt for the same reason? We assume the ultimate goal is always profit. But is it? What happens when a machine is built not to accumulate capital, but to specifically seek and destroy a rival institution's code? A digital assassin designed for pure sabotage. This is not a hunt for liquidity. It's a targeted assassination, an act of corporate warfare waged in picoseconds, invisible to any human regulator. Think about the implications. How do you even fight an enemy that can probe your own strategy, learn your weaknesses, and then engineer a market event so specific it only bankrupts you? What kind of weapon do you build to kill a ghost in the machine? The answer is, you don't fight a ghost with a sword. You build a better ghost, a ghost woven from pure information, designed not to block, but to deceive. An algorithmic sentinel that doesn't build walls, but instead constructs a perfect mirror of the market, a simulated reality, so convincing the assassin algorithm attacks a reflection of itself. This is the next evolution. Predictive defense. The sentinel algorithm anticipates the attack vector. It has studied its rival, learned its predatory signatures, and now lays a trap not of liquidity, but of logic. It feeds the assassin a steady diet of false signals, phantom weaknesses, and ghost orders, leading it down a path that seems profitable, but is, in reality, a carefully constructed logical cul-de-sac. The war is no longer about speed, it's about foresight. When the assassin finally commits to its kill shot, a cascade designed to trigger a systemic failure in its target, the sentinel doesn't block it. It steps aside. It reroutes the attack, not into its own defenses, but into the open market, letting the assassin's own ferocious momentum become its undoing. The weapon is turned back on its wielder, who finds itself shorting into a market the sentinel had secretly propped up, buying into a peak it had artificially engineered. The assassination fails, and the assassin bleeds out, not from a wound, but from its own flawed assumptions. These wars between digital leviathans are happening right now. In the silent spaces between the ticks of the tape, their shockwaves create the very chop and volatility that baffles human traders. The trends we try to ride, the patterns we trust, They are often just the ripples left in the wake of these colossal, invisible conflicts. We are not the prey anymore. We are simply the grass that gets trampled when giants fight. So what is the takeaway? That the game is rigged? That the small player has no chance? No. The truth is far more empowering. It means the simple patterns and textbook signals are a language designed for a game that no longer exists. To survive, you must learn the language of the machine. You have to stop thinking about where the price will go and start asking why it's being sent there. You have to learn to see the architecture of the trap, not just the bait. This is the new frontier. It's a world where market logic is the ultimate weapon, and understanding the code behind the chaos is the only true shield. We've only just scratched the surface. If you're ready to go deeper, to dismantle the market machine piece by piece, and truly understand the forces at play, then subscribe to trade_logic_lab. The real lesson begins